Out of the so-called Magnificent Seven, 5 stocks are down more than 10% from their annual highs, led by Tesla. That one is down more than 30%, and with bond yields reaching multi-year highs, and with the higher for longer narrative at play in the interest rate world, how should investors position their portfolios from here? Joining us to discuss is our own Mike Santoli and Mike Bailey, Director of Research and Investment Committee Chair at FBB Capital Partners. Mr. Bailey, let me ask you first, what do you think? Is this an enduring slide in these stocks? Only 2 of them are not down more than 10%, Amazon and Alphabet, but they're close.
That's right. It's a tough spot here. So, we've had this massive run here the first few months of the year. We did see 3 of these names really outperform significantly, and in particular, sentiment really blew up. I would kind of take the group down to a smaller group of, call it 3 amigos. So you've got Tesla, NVIDIA, and Meta, just massive increases in sentiment. It almost sounds kind of childish, but the bigger they are, the harder they fall. So we've really seen a lot of compression back in terms of sentiment falling for those 3. We've seen sort of a follow-on effect for some of the others, but I really think it's that sentiment driver. It can, run up really high quickly, and then you can also see a reversal. Looking in terms of what investors should do, I think these are generally good companies. I think you can pick your spots. The one name that jumps out for us, it happens to be, more of a modest correction territory, is Amazon. Compelling growth. Interestingly, you can buy Amazon for the same multiple as Costco. So for us, that's pretty compelling. 2 retailers out there. I think Amazon's got the lead in terms of long-term growth. So I think there's some of these names you can still own.
Mike Santoli, can the market go higher if these guys don't?
The math becomes pretty tough if they don't participate at all, or especially if they just keep going down. But a few observations. One of them is, you talked about the declines, peak to trough, from these stocks. The overall S&P is down 5%. Mm-hmm. So clearly, it's not going down dollar for dollar.
And yet we're talking about correction here.
Well,
some people are, and this is not by any stretch a correction. I mean, it may be for those stocks that have gone down 10%.
That's right. I mean, it's not yet, broadly speaking, in any appreciable way. Now, I'll say the NASDAQ 100, which essentially is dominated by these 7 stocks, was a 36 percentage point advantage year to date 1 month ago over the equal-weighted S&P 500. Now it's 28 percentage points. In other words, it's given back 6 percentage points of outperformance that had built up into mid-July to now. So has that changed the overall leadership complexion of the market, or is it just really that's where more of the air was underneath these stocks? We hit August. The overall market was a little bit stretched. We are definitely dealing with at least what the implications are of higher bond yields, but also of faster economic growth. These aren't the ones to own if you think the economy is reaccelerating. So I think all that's in the mix, but it is very difficult for the S&P 500 to perform without them stabilizing or rebounding.
Dan Niles, the tech investor, tweeted an hour ago, bond market stabilizing, covering half our shorts today, expecting a short-term bounce next week, doubling Meta position, buying Apple, and so forth. So, Mike Bailey, how important are stabilizing rates to the next leg of this move here?
I think it's pretty relevant. I mean, if you look at really the overall market correction and the Magnificent Seven kind of takedown, that's coincided with a rise in rates. So I think rates are definitely critical to the conversation. If you get something unexpected out of Jackson Hole next week, if rates continue, moving north, that could be a challenge for the broader market in general and some of these big tech companies, which are pretty rate sensitive at this point. Our guess is we're not going to see that significant move up in rates from here. We saw a little bit of give back even from yesterday, but Fed's kind of a black box. We're going to have to wait and see what comes out of Jackson Hole next week.
What would you add to that, Mike?
Well, Kelly, you are one of my several great adversaries in the debate about how rate-sensitive growth stocks are. I'll just point out that they kind of detached coming into this year. If you looked at the Treasury market versus NASDAQ 100, obviously it matters, but it's not, to me, the one thing that matters, especially when you're talking about the super profitable large companies like the Apples and the Microsofts.
I would say from observation, it feels to me like it matters minute by minute more than it matters month by month.
That's exactly right.
If that makes any sense.
No, you're right. We're locked into a point where the main swing factor in whether I'm going to take more or less risk in stocks and in big growth stocks is, are yields going to become unhinged to the upside or not?
Right.
And so that's why you do get that tactical relationship. But if you go over a longer period of time, I mean, I looked at the last few times the NASDAQ 100 traded at like 25 times earnings, which is where we are. And the 10-year yield was anywhere from the current level to 1.5% to 5%. And then if you want to go back to the late 90s, then, all
Even
the math
higher.
doesn't work, basically.
No, it's true.
All right, Mike Santoli, Mike Bailey, thank you very much.